Now we're loading the corn chart up. And we had the corn announcement come out yesterday, the ag report. Let me see. Let me pull up my on the ag report over here. What do we got? One more second. I had it up. And my computer just seems to be going a little slower than I like. Okay, here we go. All right. So looking at corn, let me bring the chart back to the screen so everybody can see it. And okay, I'll have it all up and ready for you when we get back right after this break. And a nice move today as well. Stay right there. All righty, folks, so come on back here to the Diagnostic Trading Hour. And we're looking at the ag reports that we had this week. And give me 1 second so I can pull that up. I got corn up for you right now and ready to go. Ag reports, love trading them. I don't know if y'all have traded them before, but they can be really, really cool to hop in on and take advantage of. Let me see here, but I got one of them. We got John on the line. John, how you doing?
Darrell, very good. Darrell, I called in to segue right into your discussion on the USDA report and the ag derivatives, corn. So I'd love to hear you tell us what you were doing with that. All right, let's run back here to the USDA report. We had, wheat, corn, and beans as something to potentially set up coming into this report. What attracted your attention, please, on this, and what opportunities did you see just by way of review?
Let's see here. Remind me, because I'm pulling up so many different things right now. What time was that? What was that on? I'm still flying through all
the corn, the USDA reporting came out today at noontime, New York time.
Yeah, there it is. Okay, yeah, I'm like, I know I have this on my list because I'm about to go over it. So the one that came out at noon, as you can see over here, I'm usually going to hop in as early as I can.
Yep.
And I'm going to look for as cheap of a strangle as I can pull off. And let's see here. So what do we got? There's something up with my... Yeah, hold on. I need to check my connection here. I think I haven't rolled it over on this. I got 3 different computers that I use. So let me see. Let me update my corn real quick on this computer. But basically, I'm going to look for, obviously, a strangle on the trade, unless the premium is just insanely expensive. Okay?
Right.
So that's one of the things that I try to teach people to think about whenever they're looking at these strangles or butterflies or whatever. If you look at butterflies and it's just too freaking cheap,
yep.
Well, then that's a really good clue to go in and, do a strangle. If you are looking for a strangle and it's just way too expensive, then, that's your clue to go in and do that. So I'll just put up on Thinkorswim because I'm having a issue on that chart updating where I want it to. All right, so right over here, pull up ZC. Then let's back it down to 5-minute contracts. And then the way that Thinkorswim plots is a little bit backwards. They plot bar open versus bar close on their timestamps. So right there. So here's you can tell where the report came out. Okay?
Yep.
And so if I'm going in to strangle this, we're at like 376. Then I'm usually looking for, a 5 to 8 point move on corn or soybeans. So, if I put it 5 points above, then I'm looking for, close to a 380, 381.
Yep.
Let's see, the release happened at 376. So, 5 points, about 381. So I'd be going in and looking to buy a strangle for ideally less than $25 to $30 if I can get it. Okay. If I can't get it, then I'm going to put in my take profits. I'm going to put a sell to get out at 43 on my buy side. I'm going to put a buy to buy back at 57 on my sell side. Okay? So if I bought at 50, let's say I bought it 10 or 12.50 and then I sold it, say 88.50. Okay? So I need to have my take profits in there, and it's really important on news because it can pop up, hit it, and pull right back.
Right.
Okay? Now, if I go in there and I'm like, this thing's going to cost me $40 or $50 to do a strangle, right? Then, what's today, was pretty high. It's going to do a strangle. It's not going to work out real well.
Right.
So I'm like, you know what? There's a lot of extra premium built in my favor on this. If I can go in and pull off a $45, $50 butterfly where I buy the strike below and sell the strike above, I mean, I don't care if it blows through it because I expect it to pull back, which is exactly what happened. It popped up, it pulled back, it stayed right within inside the range, allowing me to collect the premium on it versus hope it moves far enough. Does that help?
Hang on and do soybeans just when you return.
You got it. All right, welcome on back here to the Diagnostic Trading Hour. And I currently have John on the line from Philly. And we're going over corn and soybeans. We just talked about corn. Soybeans, we're basically looking at about the same thing. We're talking about the ag reports that come out. And they're listed over on the USDA's website. So if everybody wants to look up those future dates. Next one, by the way, will be May 12th. Okay? So you want to go over soybeans? Is the questions about the same on that one? Like, how do you handle that?
Exactly.
Okay. I'm basically doing the same thing, except for I usually look for an 8 to 10 point move on soybeans. Okay. And so I'm going to look to see if I can pull off a strangle again for right around 25 or 30 bucks. If I can't, and I can pull off a butterfly for 40, $50, okay, then I'm going to do a butterfly. So because what you'll see on a lot of these reports, it pops out, pulls back. So on the corn and soybean reports. And like, so today, if you look at it, I mean, we got a nice move. We got basically about a 7.5, almost 8 point move, right? Actually, I think we're right about 7 to 8 points. So it was within the expected range, but the premium was too expensive to pull off the strangle.
Right.
Okay. So your only option was either no trade or consider going the other direction.
Got it.
So, and again, I do want to get at least 40 bucks on these trades. Like if I'm going to do a butterfly, okay, like combined out of the two.
Understood.
So that, because I don't want to, the hard part is I don't want to use a stop loss on these. So, which the nice thing about, butterfly, like, binaries, you don't have to use a stop loss. The reason I don't use a stop loss on these is because sometimes I'll see it pop right through and pull right back.
Right.
Now if it pops through and doesn't, and it pulls back and then, starts coming back down, or if it goes down and just keeps going down and then does a slight pullback, I'm going to be very tempted just to hop out and cut my losses, okay, and less of a loss.
Right.
But the IV is going to go down anyway, so you're going to get some volatility crush in your favor, regardless, okay? So, but usually what I'm expecting to see on a butterfly on corn and soybeans is a big move in one direction or the other, and then within I'd say 5 to 10 minutes, okay, an instant pullback on the trade. If I see that, then I can probably just leave my trade alone until expiration. Or if I get I have like $10 left of max profit, like I'm at like 95 and 5 or something. Well, then just then why risk it?
Right. Exactly. Yeah.
So you give up some of your profit, but you've locked in the profit at that point. So you're okay. That's really just how to handle it. It all comes down to the best practice you can do. And I mean, if you have a pen and pencil, I can read these off to you real quick. But or you can just go to the WSD website, but on USDA.gov. But January 12th, February 10th, March 10th, and then of course today, April 9th. The best practice you can do, this is what I do, is I go back and I look at each one of those days. Okay. And I go, how far did it move? Did it continue moving? And I look at, basically those daily expirations by 2:30, what happened? And look at the pattern and see if you can, you ought to how far did it move? Did it pull back? Did it pull back and then start to trickle back down? Like right now, it's sort of trickling back down, right? So now if we had our, binary, if we bought it, say at 9, 50 or something, we'd be fine. But I'd be out of the trade already. But, if I would have held on to it, what would have happened? If I would have sold it, what would have happened? And to help simulate that a little bit, what you can do is, because you need to know basically how are the strikes set, okay? So that way you can have an idea of, at least theoretically, what were the strikes when you're looking backwards. And so I'll teach you a trick. It's a little bit different on corn and soybeans. The trick is look at the strike widths and how wide they are, and understand that they are set at 6 p.m. Eastern time. So if they're 6 points wide, look at 6 o'clock, add 666, subtract 666, and then you'll know what the strikes were for those historical days you're looking at.
Darrell, thanks so much.
Hey, you bet, man. You have a great one.